So how does this outcome from the policy change that we saw yesterday amend or adjust your expectations for 2025? We can just talk about the first quarter if you like, but how does it impact your expectations more, broadly speaking?
I think that it jumps back to that whole relationship of dissecting the rate of change, understanding the dynamics of rate of change. So what we had before is a rate of change of easing that was faster, and that rate of change is now shifted to be a more gradual easing slope, right? So
Yeah.
instead of showing or leading the market to have 4 rate cuts for 2025, the Fed median dot plot projection is now 2 rate cuts. Now, the Federal Reserve will be quick to tell you that our dot plots are not, a formal forecast of the full committee. It really is just individuals kind of marking their view of where the Fed policy will be, but it doesn't kind of account for the consensus agreement that ultimately forms in each FOMC meeting that you have, that we're going to be seeing here in over the next 12 months. But it's still important because the market is a forward-looking mechanism, and the markets seem to have been priced to perfection, meaning that we've had re-ratings up higher. And I'm mostly talking about equities, but we have more secular themes happening in the digital asset space, which we can get into. But with equity markets seeing such a tight consensus window of being very bullish with their 2025 forecasts, it leaves little room for error.
Yeah.
So when you have the yields go up as they did following the latest FOMC decision this week, you'll find that the markets have to kind of reprice. And whenever you see such an aggressive sell-off, in markets, it's very rare to immediately bounce back. You know,
Yeah.
that typically signals a market structure shift to lower prices. And I expect in the near term, to answer your question directly, in the near term, we're going to have a lot more volatility. We're going to have, I think, a lot of the run up that you saw post election is going to kind of be rebalanced. It's going to maybe chop around in there until we go into some of the themes that we're talking about that could
Mm,
force the Fed's hand
yeah.
to come back to the table.
Yeah. And Mark, just give us your view,
Yeah.
then we'll jump into the main thing. There's so much to talk about.
Yeah. So for me, when I see like a more hawkish pivot from the Fed and I see that those interest rates pick up at the long end, what I kind of look at within not just equities, but digital assets too, is by market cap. If you look at what's going to kind of, whether the sell off the best or whether a downward repricing, it's typically large cap. It's a lot of the small cap stuff you're not going to see probably do that well coming in to the next quarter. That's what's going to get hit the hardest because those are, think about it, longer duration assets. Cash flows are further out, and now you have a 10-year over 4.5%. It might take some time before a rotation back into small cap happens. So you might see, large cap, more defensive things kind of outperform here in the next couple months.
Yeah, and when you say large cap, obviously it's got a dual meaning nowadays, and
Yeah.
small cap as well. So, are you actually looking at the alts, not necessarily just the memes, but the small cap tokens as well?
Yeah, so like especially small cap tokens. So I mean,
Yeah,
anything under a billion in market cap or so is what I would consider small cap. That's going to be the stuff that really gets hit, or anything that's also things that have seen a run up post election. You might get a reversal, and you'll see it kind of trade back into some of the ranges it might have been down there.
you're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance, presented by CF Benchmarks. Hey everybody, thank you very much for joining us for another episode of CFB Talks Digital Assets. I'm Ken Odeluga, Head of Content, and as usual, I'm pleased to be joined by my colleagues and friends, Gabe Selby, Head of Research, and Mark Pilipczuk, who is a Research Analyst. Hi, gentlemen.
Again, awesome to be here.
Brilliant. And indeed, it is awesome to be here because it's just the market, it's just the asset class that keeps giving. And the gents have just released their 2025 market outlook. And so that's what we're going to discuss today. It's been an action-packed seismic year for crypto. And if anything, next year looks to be at least as impressive and exciting. Now, of course, life comes at you fast. So what we've seen overnight, literally as we're recording this, is, of course, the Federal Reserve interest rate decision, the last one for the year. And the market absolutely went bonkers in the wake of that decision. So yeah, gents, I think that's where we're going to start this. So the Federal Reserve, as predicted, did cut the Fed funds rate by 25 basis points. But that's just about all that was predictable about the both the policy decisions and the market reaction. So who wants to get into this first?
Yeah, I can kick us off. You're right to say that a lot of us were expecting this. I think a lot of the progress that we were seeing in the first half of 2024 started to stall out. So some of the preemptive work that led them to do their 50 basis point rate cut earlier in the year is kind of fading away. So what we've kind of said in our outlook is we're seeing, measured cuts, but we're not having a victory lap yet. Essentially, the Fed is now guiding us on a more gradual rate cutting path. Before, in the September meeting, they were leading us with 4 interest rate cuts for 2025, which would be 100 basis points of total cuts. And now we're seeing them trim that down to 50 basis points or two rate cuts. So the markets, I think, were mostly focused on that, the forward guidance and what that meant. And that's kind of why you saw that type of price action in stocks and in bonds and also in digital assets.
Sure. And Mark, your color and your reaction to what we've seen in the last 12 hours or so?
Yeah, so one thing that I was actually looking at was the strength in the dollar following the Fed press conference. We saw the dollar index tick up over 108, which was I believe a new high. And this is actually pretty interesting. This goes into kind of interplays with the regulatory environment a little bit. We're talking about tariffs coming into next year, and a stronger dollar might actually help offset some of the inflationary pressures from tariffs. Because if you think about it, we're able to purchase foreign goods with a stronger currency. So even if there's a 20% tax essentially added on, we can actually buy more goods with our dollars to kind of offset part of that. So that was a positive development out of that.
I mean, is it too much of an overreaction? Is it an overreaction to say that what we witnessed last night? I mean, we talked, earlier about the 10-year yield rocketing to, I mean, kind of similar levels really in 2022, but slightly more. And so therefore the biggest reaction on a FOMC night or afternoon since the taper tantrum of 2013 or 2014, something like that. But yeah, clearly not anywhere near that level. But nevertheless, in terms of, an ordinal change, yes, the second biggest reaction. Is it then too much of an, overstatement to say that we saw a regime change, monetarily speaking, last night?
I don't think so. I think
Okay.
if you're considering the where the positioning was heading into this week, we know that consensus forecasts for next year are pretty optimistic. Mostly talking about the equity market, since we don't really have consensus forecasts for digital assets yet. Maybe one day we will, but until then, we're just going to work with kind of like the other risky asset that's over here on this side of the spectrum that we can kind of gauge. But 12-month targets have been pretty concentrated in the upper range, forecasting for an average year of equity market returns. If you study equity market returns, you know that average years are actually very uncommon. It's usually the tails that you get, and the average is the outcome of those tails. So I think it's very healthy that the markets get some sort of re-rating following such a quick run up after the election, and I think that's totally measured. I think also what Mark was highlighting there, as far as the yield movements up, it's kind of mostly stemming from. Let me rephrase that. The dollar moving up, it's mostly stemming from the yields and the divergence in the monetary path. So, we break this down in our outlook. We highlight a little bit of what the ECB is doing, what the BOE is doing, what emerging markets are doing. And you have, the ECB basically on a easier glide path back to neutral. The Fed's kind of stuck with stubborn inflation. In emerging markets, China's got outright deflation. So it's kind of creating a very kind of broken off pathway for these central banks across the globe, where the Fed is kind of the spotlight and center of attention normally. But when you have the Fed having to hold up here and bond yields in the US taking up, you're going to see a stronger dollar. And it will help offset the tariffs, in the near term, but it also kind of makes you less competitive, right, for
Yeah, yeah,
exporting. So
yeah.
it's kind of a double-edged sword. And what we know in context of history is that the dollar has been very strong for a long time, and therefore buying U.S. imports has been quite difficult.
Mark, are you as sanguine, maybe as relaxed about the change in the outlook, any change in the outlook following last night as Gabe is, or
Yeah. So, well, when I think about the press conference and what came out of that, when we listened to what they were talking about, they did discuss. Jerome Powell did say they still acknowledge that that rates are restrictive, and they still did
yes, they
talk
did.
about the path to neutral in the press conference.
Yeah,
So it's not really anything's changed with the policy. It's just a shift in timeline. And then when you have that shift in timeline, the market's gonna get a little uncertain, create some volatility, and try to reprice for when it thinks that we're gonna actually get to that neutral rate.
yeah.
So it's just like, to me, it's just a longer timeline essentially.
Yeah, I want to talk about bond vigilantes in a second because I think that's an important aspect of the potential outlook and how the impact on you guys' outlook for 2025. But just a bit of a contour. Gabe, you mentioned the ECB and you mentioned China. We didn't mention Japan, but let's talk about rest of world macro very briefly. I guess particularly with respect to the potential impact or the potential sway that, as we can see, quite significant divergence that we're seeing ex-US can actually circle back to impact US, whether on the policy side or whether mechanically on the actual sort of like a market side. What are your views on that, guys?
Well, I think that Jerome Powell actually talked a little bit about this in his press conference, where he highlighted that the U.S. has been kind of a bright spot in the global economy. And, we just got GDP numbers latest revised to be north of 3%. He was just mentioning that whenever he's in these international meetings with other central banking leaders, the topic of discussion is how well the U.S. economy is doing relative to the rest of the world. So while the rest of the world is tending to risks of slower growth, and in China's case, they've got property market issue, they have outright deflation, you have commodities in deflationary mode, which is very kind of tied to Chinese economic activity. It makes total sense that you're getting kind of the price action and effects and also these types of markets, but it also just means that we've kind of put ourselves a bit in a tight spot in terms of how do we get the U.S. back to neutral. I think we are kind of seeing that Fed reaction function work into a more hawkish zone a little bit easier than what we anticipated last quarter with our outlook. But when we talk about bond vigilantes, I can kind of break down where I think that's gonna come into play next year.
We can jump straight onto that now, but I think Mark, you want to say something, or
Yeah, I think.
yeah,
Well,
go
I
for
think
it.
the bond vigilantes
Yeah,
is the big.
it
That's
is.
that's going
Yeah,
to be the topic of discussion there.
yeah, yeah, yeah.
So yeah,
Um,
let's get into it.
let's jump into it. Yeah, because so guys, I was literally scrolling while Gabe was talking. I was listening, Gabe, but I was scrolling because I wanted to find your section in your outlook. It's in the monetary outlook, I believe. It should be on. I want to say page 8. Now, you guys had a really prescient section in your outlook. The subtitle is Bond Vigilantes, Will Borrowing Costs Force the Fed's Hand? And in our little sort of like preamble before we jumped into the main recording, I believe Gabe correctly noted that no one else was, in particular, was talking about this aspect or this possibility. And I believe that what we saw overnight with the 10-year yield spiking, the SPX doing its biggest drop on a FOMC decision since 2001, apparently, I believe that we actually saw the return of the bond vigilantes. This could be a major topic, certainly a major influence on policy, and of course, if that happens on markets in 2025. So let's dig into that topic. Gabe, maybe first of all, you should outline the history about this idea, what it actually means, and what it actually means for markets.
Yeah, let me outline the historical context, and we can
Yeah,
talk a little bit about the debt dynamics that accompany
makes
that.
sense.
And so basically, as we've seen deficits rise here in the US, we've seen the service or the interest burden of that debt continue to rise. And that's now starting to breach the 4% of GDP mark. That brings us back to the 1980s, 1990s, where we first kind of saw bond vigilantes make headlines.
Yeah.
So it's kind of like the dots are starting to connect here, as far as we're starting to see some folks talk about bond vigilantes, and what that kind of will look like, in 2025 is when we start to observe each treasury bond auction. There's significant risk now that the bidders just simply won't be coming to the table.
Mm.
We already know that Japan's not buying the debt anymore. Some of these typical foreign investors are not so keen to purchase treasury bond yields as much as they were in the past. So it's been falling a lot on the domestic investors here in the US. The risk that, the prospects of higher supply, more supply coming out of the market, higher growth or inflation expectations vis-a-vis animal spirits or tariffs could potentially lead us to have, more like more yield tantrums in the treasury market. And we outline various kind of unconventional, not entirely unconventional, but more creative approaches to solving this problem that the Fed might do. So one of the things that we highlighted is, will we see a return of QE? Will we see more asset purchases? Are we going to see yield curve control? This is something that gets closely tied to the Bank of Japan, but actually the U.S. had yield curve control in World War II. So maybe they'll step in and try and target explicit ranges for their yields to help kind of cap the borrowing costs. But if we distill this down to what it means to the portfolios, what it means for investors, is that you're going to see more debt monetization. You're going to see, potential debasement risks with the US dollar. And that's where I think the Bitcoin train is going to continue to chug along. And it's going to kind of have this secular tailwind because of these risks.
Yeah. So even I wasn't born during the time of the original US yield curve control. But Mark, I think you weren't around in the previous Bond Vigilante raid. What is your reaction to what we saw last night, and also just in general, the risks incumbent upon that kind of reaction by the market?
Yeah, and one thing that's kind of helpful to look at is the context we're looking at this in. So back in June, the Congressional Budget Office, they published their long-term forecasts for where the debt levels are going to be and where our debt as a percent of GDP is going to be. And if you look at those projections and the actual interest rate assumptions that go into them, the 10-year the bond interest they're expecting to pay is anywhere from 3.4 to as low as 3.2% in the projections. Right now, we're sitting at close to 4.6% on the 10-year.
Yeah.
So, and if you look at their projections, they aren't projecting the interest expense to shrink as a percent of the GDP. They're projecting it to grow at those lower rates.
Yeah.
So that's what gives us the idea that they may need to look for some type of solution, because if you take those projections and run them over 4%, the interest expense on the debt can really start to compound and get away from you to the point where there's not very much you're able to do about it unless you significantly cut government spending, or you essentially would have to cut rates to zero and refinance everything.
Yeah.
But
what happens if you account for tax cuts?
Yeah, if you account for tax cuts, then we have an even wider
Yeah.
Yeah,
No, it's a good point though, Mark. Like that's what the CBO was forecasting in June. We've had things change, We're talking about lowering taxes, increasing deficit spend. I think Trump just recently announced his support for removing the debt ceiling. Look, personally, I'm for that. I don't think the debt ceiling is very practical. It's become kind of a political thing.
Yeah.
But it kind of gives you a hint of where, we are kind of steering the ship, and why that's probably going to be, I think, constructive for an asset like Bitcoin, right?
Yeah.
Yeah, and it all kind of comes down to what's going to cause they have the real economy to worry about. What's going to cause the least pain? And the answer to that is it's likely the devaluation of the currency scenario. If we run a little bit hotter inflation and we kind of get yields under control to reduce the interest expense, we could maybe work our way out of the deficit.
Just reading that section, my impression was, I mean, you talked about potential Fed intervention should the vigilantes, really flex their muscles. What does that look like, though? I mean, and also, is it in the sense of a corrective goal, or I mean, there is the other sense, of course, that the Fed gets back into a corner and it actually reacts. So those are two kind of prongs. Let's deal with those as well as potential outcomes that we might be seeing in 2025.
Well, I think before we get to that point, we could start to see some tensions between the executive office and the Federal Reserve. This has historically happened before in Trump 1.0, where we had the Fed on autopilot cruising up with 25 basis point rate hikes in 2018 up until the point where the markets had a 10% correction. And President Trump got pretty vocal against Jerome Powell. So I think the dynamics here are shifting in a sense that you're going to want to see, you're going to pay attention to the relationship maybe between the executive office and the administration with the Federal Reserve going forward, if they choose to stay on a hawkish path, assuming that they do, assuming that the Fed does engage in sort of these creative measures. What it's going to look like is they're going to try and target yield ranges, which would lead to purchasing X amount of treasuries on at each tenor and try and cap the borrowing costs. The U.S. is fortunate in a sense that it has the world reserve currency. It has a fiat system, and that allows it to print its money. What that impacts is, I guess, your future purchasing power as an individual, and you need to look for ways to protect that purchasing power. And that's been kind of the key theme that we're seeing here in Bitcoin's narrative.
Guys, obviously we could just really make the podcast about the monetary stuff alone, but we're nearly halfway through, but unbelievably, and we really haven't talked about what we really want to talk about. What I do want to ask you though before we jump in that is, obviously last night the other thing that happened is Donald Trump, president-elect, made it clear that he was not happy about the proposed raising of the debt ceiling, which I believe, if I'm understanding this correctly, was supposed to happen a week from the recording of this podcast. So what does actually raise the specter of is another government shutdown. Obviously, the federal government not being able to basically stay open because it's does not have the cash on hand to actually keep itself open. I think history has actually shown us that generally these things get ironed out with a bit of a fudge. But what it does show you, at the very least, is that this is going to be happening quite a bit under the new guy, and that's going to have an impact. So maybe you guys want to sort of like speak to that very, very briefly.
Yeah. So for me, like looking at kind of the government shutdowns and everything, we had one back in 2014 when they had a
Yeah,
similar
yeah,
budget issue.
yeah,
These typically aren't too big of a deal for most people. What it does is it's like if you're a government employee, you won't be working, but you will be back paid whenever it comes back in. So that like element of money going into like people's pockets and hurting the consumer, it shows up in the short term, but not really too much. The other thing is like, if you think about things like Social Security, that will continue to pay out and other government programs will continue to work. So it's really just a little bit of a pause. Yeah, to me, it's kind of a nothing
yeah.
burger.
I mean, generally markets don't generally like them, but my perception is, and my memory is, that markets don't generally overreact to them. So there is that.
Yeah, it's really depends on how long the shutdown lasts. I
Good point.
mean, we've had shutdowns even more recently, but if they last a week or two, it becomes more noise than signal. I think that with the direction that we're going to, the debt is going to be the next kind of battleground. And I'm not exactly sure how we get to a place. We can talk a little bit about the Department of Government Efficiency. We can talk a little bit about the Strategic Bitcoin Reserve, but there's going to be a lot of unknowns going ahead.
Yeah. Do you guys want to talk about the growth outlook at this point? I looked at the forecasts basically it's like a conglomeration of forecasts that you've got in the Outlook report. And I think I'm correct in saying quarter on quarter, seasonally adjusted, 2.1% versus 2.7% in 2024. So how do we get there in your view? How do we actually, what are you seeing that's actually bring us to a lower growth rate at the end of 2025 than we've seen at the end of 2024?
I think that it's the story for the growth outlook is going to be centered on tracking the soft data, aka the animal spirits, and tracking that soft data to see if it bleeds into the hard data. So we have a nice chart on our outlook which measures small business optimism and consumer confidence around the 2016 and 2024 elections. And we saw kind of the same reaction in 2016. Whenever you have a pro business, pro growth type administration that you're going to see here with Trump 2.0, it really is quick to boost those animal spirits up, and that shows up in soft data. But we also saw in the first round that the soft data did not quite fully bleed into the hard data. I still think that with the momentum that we're seeing here in the US, it's very strong, albeit I think the labor market's slowing a little bit faster than what the Fed's probably projecting. I think that the growth for next year is going to be a good year, and it's going to probably be mostly attributed to that soft data spilling over into hard data.
And Mark, your perceptions on growth, I'd love to hear.
So another thing that I'm kind of looking at when it comes to our GDP growth is government spending has become a big piece of GDP, and we have the potential for the Department of Government Efficiency, the DOGE, to come in and maybe make some changes there. Although that could have a little bit less impact than people are expecting, because a lot of the at the end of the day, it is Congress that sets the budget, and they are a non-government organization. They're an advisor, so they can make recommendations to what Congress can do, but it's ultimately up to them to address spending in the budget. So you'll likely see from the government side probably not much of a change, and then like Gabe said, with the consumer, it's going to be to see if that confidence and that small business confidence translates into actual economic growth.
Brilliant. And guys, so, obviously the Fed forced us in our chat today to slightly do this, back to front, where we talked about, the monetary outlook, policy sort of outlook first because of what we saw overnight following the Fed decision. But, we just had an amazing year. And let's recap that to an extent, because obviously that can give us a lot of insight about the year that we can expect in 2025. So, obviously, the banner things are 37 billion in net fund flows. We were now sitting at 50 billion in total AUM for crypto, and we had an amazing year on prices, pretty much across the board. What particularly do you want to tease out and take forward into 2025, chaps? Maybe Mark, you should go first on this occasion.
One thing that I've been kind of looking at from a secular standpoint is what kind of capacity and user growth can these blockchain networks actually handle? And we covered this a bit in the scalability section of our outlook, where even just 5 years ago, you had your major networks like Bitcoin and Ethereum. You could only process like low double-digit transactions a second between the two, 15 to 20 total. I mean, now with Ethereum Layer 2s and Solana, we have the theoretical capability to process tens of thousands of transactions a second. So we're able to exceed credit card networks for payments, which is a good thing. Payments are just one thing that happen on chain, right? We also have DeFi and other applications. So we now have the headroom to actually go ahead and do all these transactions. And there's a chart in there that shows the block space utilization from the last 5 years. We were about 90% full. And by 2024, we're only using 1% of the block space. And what you'll note is the actual transactions per second processed across chains is going up. So a key driver of a lot of this secular growth coming into 2025 is we now have the capacity to actually do all the things we've been talking about for the last 5 years. So DeFi, if you think about the amount of trading and volume you're going to see, we're seeing it approach $50 billion a week at the end of November. You'll probably see similarly high volumes all throughout 2025, especially with a regulatory unlock where it might be easier for people to gain access to these things. If it's easier for people to buy crypto, it's easier to onboard, and there's kind of clear guidelines, then you'll really see that start to open up.
Yeah, we've gone secular, which is perfectly great. I just want to draw a little bit of attention to the beautiful chart that the research team have put together on the page that's headed "Scalability to be tested in 2025." Because what it immediately makes clear is, I mean, it's basically a bar chart, bar charts, major L1 utilization rate, right? So you've got those are the bars. Then the line is actually major L1 TPS. So throughput has shot up, and utilization has collapsed, essentially. Judging by the historical scale. So, what are the implications of that? And maybe Gabe, you can take that.
Yeah, I think we're seeing a lot of changes, and one of the changes is going to be kind of the shift in economic incentives. Before, where you had this block space kind of scarcity, and that really drove a lot of the value. I think we're going to see some of this unlock create user-friendly conditions and allow for this network growth to be kind of the new priority. So it's all about, I think, enhancing the user experience, in this cycle. I think you're going to see a lot of consumer dApps become more mainstream. So I think we highlighted things like, you're going to see a larger NFT ecosystem. You're going to see probably a lot more DeFi activity, because we already know that DEX volumes are surging, but it's just becoming, I think, more frictionless, and it's becoming more of a consumer friendly ecosystem. And that's the key if you want to see more mainstream adoption with blockchain technology.
Yeah, I feel like we should, really dig it. I mean, 1600 TPS. That's what does that stand for? It's not throughput per second. What is it?
Transactions per second.
Transactions
Yeah.
per second.
Mhm.
Is just that's pretty much Visa. I mean, right? I mean, I think that the whole comparison over the years has been, oh, well, Visa is very far, very faster. But that as fast as, or maybe even faster than your credit card reconciliation now?
Yeah, it's pretty close to some of the volumes that you'll see Visa processing at, it's certain windows of the day, it might be higher. It hits as
Yeah.
high as 22,000 during peak windows in the US when
Okay.
people are
Okay.
using the card
Yeah.
networks the most.
Yeah.
But the other thing that it does is it's actually faster in terms of time to settlement by orders of magnitude. I mean, on Ethereum layer 2s and Solana, it's within seconds the funds have settled in the other account. And the fees, merchants are paying 3% to Visa now, or
Yeah.
sometimes more, depending on what you're selling or the volume you're doing.
Yeah.
On networks like Ethereum and Solana, you're seeing sub 1 cent transaction
Yeah.
fees.
It's
And there's also
negligible.
there've also been network upgrades now where the end user doesn't need Ether to pay the transaction fees. The
Yeah.
merchant can actually pay the transaction fees, or you can pay transaction fees using stablecoins. So you can
Yeah.
have wallets where you totally eliminate all of the
Absolutely.
crypto. To onboard users, it's much easier to onboard with
Yeah.
stablecoins. And
Yeah.
that's
Yeah.
also another kind of big
Yeah. We'll go.
story going into 2025. So
We'll
we'll
get.
get into
I
that
mean,
next.
yeah. I mean, convergence is what I'm seeing, and
Yeah.
essentially that's an example of what you're saying. I mean, from my point of view, why wouldn't you see merchants shifting wholesale to to the blockchain once obviously when stablecoin adoption sort of really it gets bedded down. Why wouldn't you see merchants moving to this type of infrastructure from the legacy infrastructure wholesale?
I think you're right. I mean, look at what you're seeing in the headlines, right? It's happening more and more frequently that you're seeing these legacy financial institutions start to interact with blockchain technology, start to build layer twos. And that's why we think here at CFB that it's smart to have exposure to these smart contract platforms, get exposure to some of these disruptive technologies that are building the infrastructure and the railways for the future. And I think going forward in 2025, you're just going to see probably more and more surprising legacy. I don't want to call them sleepy, but those old institutions kind of jump into this space in the capacity that they can, because they know of the disruptive potential around the corner.
Yeah, but to get there, of course, for that adoption, we need stable coins. We need that kind of that layer of the sort of like the infrastructure. We can call it the legacy infrastructure to be taken over, or at least to transition or to stable coins. Maybe we won't see that wholesale transition in a few years, but that's got to be the sort of like end goal. Now, to that end, of course, in your outlook document, you guys note that the stablecoin market is expected to surpass 300 billion by the end of 2025, which will be a 50% increase. Let's talk about that. But also, of course, if we do talk about that, we do got to talk about the dominant players. I believe it's Tether with a USDT market share of 70% by the end of 2025 from currently 50% now. And of course, you talk about the increasing competition. So let's unpack all of those themes as well, guys.
Yeah. So first, when we look at kind of market share and who's dominated, when we look at that market share chart, it's going back to 2022 when we had the most recent bear market. And that's really when we saw like the blue chip players, Tether and Circle, kind of gain a lot of market share, as some of the others, algorithmic stable coins tended to depeg then. When those zeroed out, that kind of shifted things around, as well as the broader regulatory crackdown in the US as we started to kind of see. We actually did see Circle lose a bit of market share as people moved offshore and started to mint with Tether and really work there. And we also saw just more participation outside the US than within, which served as a headwind for US players like Circle. But what really tends to drive a lot of that stable coin growth is it's a lot of price momentum in the market. So you'll see prices tend to move up, and you'll see people want to essentially tokenize assets, bring them on chain to trade on these decentralized exchanges. So at the same time, you're seeing volumes pick up, and we'll likely see them increase, assuming we're in a good environment for price. So we have that tailwind for price, which works its way down to the stablecoin market. And when people move into stable coins, what they'll often start to look for is they'll look for yield. And that's where newer players like Athena with their USDE stablecoin, what they do is it's a synthetic stablecoin, and they'll use the perpetual futures to actually create it. So you can earn the funding rate on perps when you're holding it, which right now is over 20%. Now there is some risk to the coin can depeg, especially if the perpetual funding rate goes the other way. But Athena's kind of worked with BlackRock in their BUIDL fund to back part of their stablecoin with these tokenized money market funds. And that's another area that growth can come from, especially in the other category. As right now, these tokenized money market funds are really only available to institutions. And when you look at the investment minimums, it's about $100,000 to mint these. So not exactly for your everyday person. But where we could get with a regulatory framework is we could see that start to open up, and we could see these things move to essentially allow permissionless trading. And that's where we would see all this money sitting in stable coins. Maybe it's in liquidity pools on Aave, or maybe it's in these higher risk protocols like Athena. And we might see people, hey, we just want to earn a money market yield, especially if the Fed is looking at staying maybe a little higher for longer, where those yields might be more attractive.
Yeah. And Gabe, a major aspect of the section on this topic in the outlook is your expectation that the competitors operating stable coins will see their market share grow from 5% to 20% in 2025. What do you expect to be driving this?
Well, I think Mark kind of hinted on it for a second there. It's the policy outlook. We're all focused on a broader, market structure framework for digital assets, but probably the lower hanging fruit that might get passed before then is a stablecoin bill that would allow for these legacy traditional institutional players to feel confident enough to issue their own stable coins. And certainly they have a lead as far as their customer base. They already offer these other products in the financial services industry. Why not start to offer tokenized dollars, right? So I think that's where I think the unlock comes from, the regulatory side, and that's just going to boost competition. It's going to boost volumes. We're also forecasting that on-chain payment volume is going to move from 16 to 20 trillion in 2025. So it's really kind of, I think, taking aim at the old legacy payment rails like ACH or these international wire systems that certainly can cost a lot of money and they're slow.
Yeah, and to your point, actually, where we were talking about traditional, could be infrastructure operators. I mean, we mentioned in our previous podcast Swift, and their collaboration. I'm not sure. I think it's a little bit experimental collaboration with Chainlink, and that's a great example to your point. You expect to see more of that kind of stuff in 2025, right?
Yeah, definitely.
Yeah.
Absolutely.
Yeah. And Gabe, and I think actually Mark, you mentioned money market funds within the tokenization aspect more generally. Let's move on to tokenization as a topic in itself. And one thing you guys note in the report is that real world assets, commonly known in our space as RWAs, currently stand at 13.6 billion in 2024. So that's now, with 63% represented by private credit and 21% represented by on-chain funds, on-chain money market funds, right? Now, what you expect to happen is real world assets to top 30 billion in 2025. You talked about money market funds. You talked about Biddle and the collaboration that you mentioned. What else is driving this space? Why do you see such a huge quantum of change in 2025 relative to where we are?
Yeah. So when it comes to the money market funds and those kind of driving growth, I'll look at that first. And what it really is it's going to be that broader type of stablecoin bill that helps onboard stablecoins, as well as just in general, as the market grows, more stablecoins tend to be minted. And people are going to look for a place for yield. And I think as you start to see these institutions especially come in, I don't think that they'll initially look to places like Aave or into some of these on-chain borrowing and lending markets where they're exposed to smart contract risk. What they're probably going to want are these fairly regulated money market mutual funds that are on-chain to put money in. So that's where some of it's going to come from. And same thing with individual investors. There have been a lot of people that have gotten burned, due to various smart contract risk or algorithmic stablecoins blowing up. They're probably going to start to look for a little bit safer of a place to hold cash to add to their positions on drawdowns. And that's really what's going to drive that. The other thing that we're looking for are watching on tokenization, but we don't think will be a theme for 2025, is the broader tokenization of equity securities, mutual funds, ETFs. There we're thinking that it's likely that we'll see a regulatory bill make its way through Congress or maybe pass the Senate and everything. But there are some extra steps to implementation that the institutions would then need to go through and check all the compliance boxes and get everything launched on exchange, which might take a little bit more time than we think some people are anticipating. So that's why we have a little bit lower of a forecast than others. If you've been looking around, so I've seen numbers over 50 billion, which is definitely possible if we see an accelerated timeline.
Yeah.
But we're definitely playing it a little conservative here on a $30 billion forecast. So there's some room for upside there.
Yeah. So guys, we are, obviously so much to get into this discussion. One of the things I actually heard in another sort of like podcast I was listening to recently was that, some of the themes that we've mentioned already, and one that I'd like to introduce are like sci-fi, but actually not so much sci-fi, it's actually science fact, right? Because this is happening now. One of them, which is very much lends itself to that kind of description, is of course crypto and AI. And when you mention that topic, you've got to bring in the whole aspect of agents. I probably lost a lot of people already, so one of you guys is going to break it down. Let's start from agents and then build from there.
Well, I think it's like the perfect confluence here of themes coming together, and so I think everybody's talking about NVIDIA, everybody's talking about Gen AI, all these different applications, and it's all creating this demand for compute power basically over the next 12 months. So for us at CFB, we're really focused on the segments that are poised to benefit. And that's where we think the computing segment on our digital asset classification structure is going to be kind of like the main winner there. But, I think the AI agent story is something that is certainly interesting, and it's probably going to drive a lot of on-chain activity for 2025. It certainly seems to be dominating the X feed that I track for my algorithm. So I think Mark, maybe you could talk a little bit about like
Yeah.
what
Are you using them,
are
Mark?
set
That's
to
what I
gain
want to know.
ground.
You
Yeah, I
actually
mean,
got some agents.
No, I don't
working
have
for
any
you.
agents deploying tokens on any of those dexes yet. But that's really what we're kind of seeing with these agents. Is the great thing about them is all these crypto protocols are totally permissionless. Anyone can create a wallet and anyone can interact with anything. So where these agents might have had a hard time kind of getting into the traditional system and kind of logging into your bank and doing stuff for you because there's filters to block this
Yeah,
type of
yeah,
stuff on crypto. I
yeah.
mean, you can kind of go crazy here.
Yeah.
And it's relatively cheap for them to do this. So where I think this is going to kind of how I think this will kind of evolve and play into things are infrastructure index. If you look at that, it's the CF infrastructure index. A lot of those tokens are actually set to benefit. A lot of these this AI agent activity is happening on layer 2s, and they're also using these data oracle protocols like Chainlink to kind of look across chains and look at price feeds to interact. And the reason they're on layer 2 is it comes down to low cost as well as easy onboarding. I mean, with exchanges launching layer 2 networks and everything and having smart wallets that are easy to get funds into. And some of these bots you can even activate on platforms like Telegram. So you can go in there, give it your wallet and get the bot and you can get going. There's also several websites now that have created deployers for them. So you can go in and write the rules for what you want your agent to do, and within a matter of minutes have something deployed and you fund a wallet and then it's off.
Yeah, it brings in so many threads because obviously we're going to talk about, as we round off, we're going to talk about the regulatory aspect because clearly that's coming for robots handling consumer money. That's definitely coming. So guys, yeah, let's I think within the secular theme section, although it could have had a section on its own, is the crypto ETF landscape. And I think the main focus in that right now is based on the most recent data we've had in terms of holders, right? It has emerged that hedge funds have been massive players. Surprise, surprise. So far this year, something like 45% of activity. I don't know how that's broken down. It's going to read the report to get the details. RIAs currently almost level pegging on 28% versus high net worth individuals and sort of representatives at 33%. But you guys expect that landscape, that distribution to change significantly in 2025. Explain.
basically what we did is we compiled 13F data, which is the reporting requirements for institutional investors over a certain threshold to be transparent and quarterly report their filings. And so it's kind of a slow drip feed. So some of this data is a bit stale in nature, but we snapshotted it as of December 17th, the latest we could, and compiled it up. And what we can see is, if you look at the Bitcoin pie or the breakdown, it's 116 billion, and it's mostly in hedge funds. The Ether pie is a little bit smaller; it's about 14 billion in AUM, and it's interestingly more allocated to investment advisors. But the key thing here to note is that for both Bitcoin and Ether, the investment and advisor share is hovering around like 30%, so 28 and 33, right? So what we're forecasting is kind of a wealth management industry adoption shift that's going to increase the proportions of this breakdown to exceed 50% in 2025. And what that's going to do is it's going to allow a nice kind of easy setup for fund flows to beat last year's record breaking. We saw, I think, net fund flows for both Bitcoin and Ether land approximately 40 billion for 2024. That was an incredible kind of like neck snapping, neck breaking, whatever you want to say, pace of fund flows. But because of this, I think this increased appetite for these products, this increased familiarity of digital assets, it's going to unlock the advisor pool of capital and create an even bigger wave for 2025 into these spot ETFs.
Yeah. So, I mean, Mark, do you have anything to add?
Yeah, one thing that I also thought was pretty interesting when we look at the breakdown of everything, we saw the large 45% of it being hedge funds for Bitcoin. And I suspect a lot of that was the basis trade that became a
Right.
pretty
Okay.
popular trade this year.
Yeah. Yeah.
But if you look at Ether, hedge funds are only about a quarter of it. So they're actually not, and they're not even the largest category.
All right.
So what might be interesting as we see the next round of 13F filings, we may see hedge funds tick up a little bit just because the Ether basis expanded on the CME.
Did.
Yep,
Yeah.
that's a good point.
Yeah.
And one thing to break down really quickly on the Ether pie is that it's got 22% in other. It's just unique. It's a digital currency group is what we suspect is kind of the one that's kind of skewing the numbers. The Ether fund. I think that the basis, bleed into Ether is definitely something that could kind of keep that more on par for 2025. That's a really good point. But, overall, I think the bigger pool of capital is sitting with investment advisors, and that's where I'm looking for the growth in 2025.
Perfect. And clearly, another aspect that can actually feed into that appetite and that momentum that we saw in terms of inflows as well as prices is the regulatory side, which is a massive piece. We really need to try and do it justice. We have done a lot of sections justice up till now, to the extent that we've actually almost run out of time, but we will give it a shot. So guys, what your report brought home to me is just the sheer volume of verbiage that has been sort of like spilled over the course of 2024 in terms of the creation of all this, proposed legislation to write the sort of like the legislative aspect with what's happening in the market and also just the space. I mean, there's like got to be 10, 12 bills on the docket, or as we speak. Now, obviously, that probably relates to obviously the ones that most people have heard of. Fit 21 amongst them, Luba Skillebrand, Keep Your Coins, just Strategic Bitcoin Reserve, and there are several others. Let's talk about the most consequential from your point of view. Gabe, maybe?
Well, I mean, it's tough to pick one that's more consequential because certainly if you were to have a strategic Bitcoin reserve, I think that would be a major, major catalyst for Bitcoin breaking out to a whole new range that we probably wouldn't even be able to imagine, pre strategic Bitcoin reserve, because what you'd create is kind of an arms race of purchasing Bitcoin, across the globe.
Yeah.
And that is kind of a game theory dynamic where, the first mover has the advantage of probably accumulating lower prices. So, the strategic Bitcoin reserve, maybe since we'll stick on that topic, and then we can talk about Fit 21 or market structure bills after. We have a table that kind of highlights various policies, proposed policies, and what are, how would that look like as far as getting them across the finish line? Like which ones require executive action, which ones require congressional support or approval, and which ones might face challenges in the courts. I think, for a strategic Bitcoin reserve, I think for now we're still seeing that it's going to require congressional approval. It's a fiscal policy measure in that sense, and therefore you have to kind of make this active decision of, how does that, what does that look like? And I think the lowest hanging fruit for us in front of us is if it were to get approved is to start off by just having a rule that, they're going to hold on to their existing, I'm not sure what the exact number. I think it's around 200,000 Bitcoin. Is that right?
Yeah, I think that
Yep.
sounds familiar.
So maybe a little more, but I know that they're selling it right now, but let's just say like it's 200,000. Okay. So that's probably the path of least resistance. And that probably does enough for the investor mindshare to kind of form a consensus that this is a strategic reserve asset for sovereign nations. But you're already starting to see that kind of show up in the state legislative proposals where you're seeing, states like Ohio, I think, just proposed a strategic Bitcoin reserve. And was there another one, if I'm missing one?
Yeah, Texas did too.
Texas as well. So that's kind of the start of that. So we outline other things, and I'll pass it off to Mark and get his takes on the strategic SRP or SBP.
The Bitcoin Act. The Bitcoin Act.
Yeah. Bitcoin reserve.
Bitcoin Act. Yeah, that is.
Yeah.
I mean, my thing with the Bitcoin reserve is I almost don't know if we even need it to, just the fact that we're talking about it gives the
Yeah,
asset
it's a
class
good
a
point.
huge amount of
Yeah,
legitimacy.
yeah,
Like
yeah,
the fact that there's a bill that's proposed, we have our now president spoke at a Bitcoin conference and talked about the
yeah.
potential for
I
one.
mean, that is
I
pretty
that is a
seismic. Yeah,
big shift from,
yeah.
previous times when
Yeah.
most leaders were dismissing this.
Well, the
So
guy
we have
himself did not know what Bitcoin was, did he? In his previous
yeah,
term. Now he's all over it.
2019,
Yeah.
2019 he said in an interview on Fox News that he didn't like it and it was competing with the dollar, and now here he is ready to
Now
embrace it as
he's a
a
hodler.
reserve
Yeah.
asset. So yeah, just I mean, just having that discussion in the US though makes other nations that want to compete to be, essentially the world, whether you want to be the world's leading superpower or the world's leading reserve currency, you have to stop and think like the risk to not doing that as another nation is almost to the downside, because if you miss the adoption of a new technology, the compounding effects of that can put you so far behind other countries that you don't have a chance to catch up. So if you're already behind, to say you're in the number 2 spot like China, you have to be thinking about this like, well, maybe we should do this to try to front run them. And then it brings that game theory element in. And investment advisors and everybody they know this. They're kind of watching the dynamic to see if anyone moves, who moves first. And that just the legitimacy from that can give you time to pause. And maybe you were on the fence about adding a 1 to 3% allocation, and now you're like, again, it has the option like return profile, and this is happening. It's probably less likely to go to zero as a result of this. So now maybe I can even size my position up a little bit.
Yeah, I mean, it's almost a genius proposal in itself. Whether or not, I mean, if it never sees the light of day, even it's still a genius proposal. Because one thing that, and to your point, Mark, it's almost like this is not the strategic reserve of your father, or your grandfather, even, because how do you do a Bitcoin strategic reserve? It's not going to be like the strategic reserve that we've seen historically in the US or other countries. Let's talk about the US, because is it actually operationally possible?
I think those are some of the risks that they would have to iron out as far as like custodying it. One of the advantages of, Bitcoin, one of the reasons why, we think it has a technological premium over gold is that it is very portable.
Yeah.
Um, Now, I supposedly, I think a lot of gold bars sit in the basement of Fort Knox or something like that, or in the New York Fed basement. Pretty hard to steal that. You need a lot of heavy industrial trucks. You got to break in, you got to carry that up. So in that sense, that technological premium, which we value, I think on the personal side, is something that's probably going to be discussed and highlighted on the federal side. It's going to be very interesting to see. I think Mark's got a great point. The risk of not doing it is kind of like the same theory that you can apply to your personal finances. What's the risk of not holding,
Yeah.
1 to 2, 3% of Bitcoin in your multi-asset portfolio versus the benefit?
Yeah.
I think anyone who's more objective would agree that the risk of, not holding it is greater than, the risk of holding it. So
Yeah. And I want to get onto the Loomis Gillibrand Responsible Financial Innovation Act. What my perception is that although a lot of people are very aware that we did actually see a heavy year with respect to proposed legislation in 2024, that was not necessarily the uppermost in people's minds. Probably stuff like Fit 21 or maybe even SAB, which didn't necessarily make it, was actually more salient. But let's talk about that, because you got at top of your sort of like beautiful table on the regulatory outlook page. The purpose you've actually delineated is comprehensive crypto regulation, including stablecoin oversight, tax rules, and SEC CFTC authority. There's a lot to unpack there. I'll leave it to you guys to do so.
yeah. So, part of the big deregulatory push is trying to get some sort of cryptocurrency framework, a major market structure bill across the finish line. So for that, I think what's really going to be key is creating a clear division of oversight between the SEC and the CFTC. Also with that, you're going to see a reduction probably in regulation by enforcement risks that you saw in the previous regime, which should be more pro crypto. That's going to allow for real compliance frameworks for these projects to confidently go to market. It's going to allow for more capital formation in the United States, which is, the largest capital market, and that's just going to boost investor confidence overall. So it's kind of like this is a major key, I think, for us in 2025 to kind of see the progress start on that. It might not get fully passed this year, but I think it does have a real shot. Some of the risks of it being delayed in the implementation or any sort of reversal in support for this is a risk, I think, for crypto markets, in the year ahead. So I think a lot of us we're seeing the altcoin performance catch up trade is kind of going to stem on the probability of a major market framework come to fruition.
Yeah. And Mark, do you want to jump in on that at all?
Yeah, so like a couple of things that are in that Loomis Gillibrand bill that I think are probably, there's a few things in there that are more likely to be passed. There's some things that are probably going to meet some resistance. So they are talking about stablecoin regulations. Again, we've discussed that's pretty low hanging fruit. That's like something they can go through. They've also talked about kind of their consumer protection, and they've really discussed like having or audit rules for a lot of these things. So that's going to be really important when it comes to capital formation. If everything's audited and there's audit standards and everything in place, that makes investment a lot easier. There's other things that they've discussed are some tax provisions where maybe making transactions tax exempt. So if you're selling small amount of crypto for payments, that might meet a little bit of resistance because it would, it still is a financial asset at the end of the day. So trying to get around those capital gains rules that are in the tax codes might be tricky without also amending the tax codes.
Yeah.
So that might, change, but there, there's some stuff's easier to get through, some of it's not, and the bill I would say, will definitely have some changes, especially with the thinner majority in the House than the Republicans might have liked. I mean, people might cross party lines for this, but that's all going to be that will all come out as they start voting on the bill.
Yeah. I think, guys, we should move to the next major bit of legislation on the docket, as it were, and maybe that should be the last one we actually cover in this final section. Although, yeah, as I say, there are several others we can talk about. Some of them look just as important. Keep Your Coins Act, Preventing Illicit Finance Through Partnership Act, but it is the Financial Innovation and Technology for the 21st Century Act, FIT 21, as it goes by, which I believe passed the House in May of this year, which directly touches on our particular business. Obviously, we service a lot of exchange traded fund, investment managers, and this bill is going to, if it passes, or if it makes it much further, it's going to directly impact that space. Now, the purpose that you've actually written down for this is within the document, clarifies the roles of the SEC and CFTC in regulating digital assets and adds consumer protections. Now, this, from my reading of it, is probably the one that I'm most familiar with, looks at least as substantial as any of the other ones on the docket right now. Who wants to take us through what it actually means, and then maybe the implications we can deal with once we've done that?
Yeah, so for FIT 21, some of the highlights of this are really on the classification of digital assets, and the regulatory jurisdiction is going to be what's important, is going to be what I'm looking at. So they have essentially, they're introducing in that bill a decentralization test, which is going to effectively allow you to determine whether the digital asset's a security or a commodity. And then once you have the determine and who you've determined it, and who is kind of regulating it, we have the path for our ETFs, which previously we had, you had to have a regulated futures market, and then you had to, show that, it was resistant to manipulation. This bill could potentially, rewrite the rules in such a way where that's not the case going forward. And there could be a clear path to get these out and to get them listed on securities exchanges, which opens up the asset class to investors who were the custody risks might be too much, or it might be too expensive to implement, or your investment policy document might not even allow you to look at anything that's not, SIPC protected and had on a brokerage exchange.
Yeah, what's your reading of it, Gabe? My sort of just to sort of maybe a bit of fuel for that fire is that as we mentioned in the prior podcast, I believe, I find it difficult to sort of envisage the regulatory apparatus putting aside these investor safety and in market integrity considerations to the extent that maybe the bill seems to be suggesting, but I could be wrong. What's your reading?
I think that certainly the surveillance sharing agreements that we have in place for our reference rates and the data that we provide and kind of the way we work with our partners, I don't see that going away regardless. I think that the SEC, the new SEC, is still going to be very interested in having guardrails around market manipulation. So with that being said, I think having robust regulated pricing data that benchmarks these tokens is still going to be very important. I think the real question will be, do we need a regulated derivatives market, of significant size? That might be something that we're
Yeah.
going to have to wait and see. Certainly, we have a few basket ETFs that are trying to convert over into ETFs, and depending on whether those get approved or not, they haven't really been shut down yet. I think that's going to be the tell, and seeing kind of like what the new bar is to meet in getting something like that greenlit. So for me, I am more constructive that you will probably more likely than not see basket ETFs, with the new SEC and also with these and just a new regulator in charge. However, I do expect these SSAs, these surveillance sharing agreements, to still be kind of like the table stakes for getting stuff approved, because you need to have oversight of these markets.
Yeah.
And some sort of consumer protection with market manipulation and stuff like that makes sense.
Yeah. Okay, guys. So to wrap things up, let's talk about, if we possibly can, about takeaways. What do you expect the reader to take away from this massive report? What general impression do you really want the reader to actually have that can be useful in 2025, the 2025 that they're living and investing in? Mark, do you want to go first?
Yeah, this is it's going to take a second here to wrap this all up into a quick
Cool.
sentence, a quick little bit here. But I think in 2025, what you're going to see is you're going to see a little bit more caution out of, whether it be the Fed or maybe the Treasury. I think you're going to, expect things to move a little slower than we might have expected. The rocket ship we thought we were on might, turn the throttle down a little bit as we digest a lot of the data. And specifically what I'm referring to is, around the world, a lot of countries are in different economic situations. The US really seems to be the standout performer, but eventually in a global economy, these things can catch up with each other. So that's kind of what I'm watching out for in 2025.
Yeah, I think a near-term pullback makes sense. You have to recalibrate for speed, like what Mark was saying. I think you've got big personalities like Elon Musk and Vivek that are leading the Doge committee, and these are folks that move very fast, and they certainly, I'm not trying to fade them in any way. I think Elon's one of the greatest entrepreneurs of our lifetime, but when you're dealing with governments, it's a different story. So the pace can be quite slow, the progress can be quite slow. Markets tend to gyrate, and like Mark was saying, we are seeing a divergence in the global macro picture where the US is kind of on an island of its own as far as how strong it is. It's very different than what the Trump 1.0 administration kind of inherited when they first came into office, which was this kind of global synchronized recovery, where you had a big manufacturing boom across the globe. Now we're seeing kind of the opposite. So I think for digital assets in particular, it's about, I think, the familiarity the comfort of interacting with the space, the adoption growth curves, as far as daily active users, new wallets, people just becoming more familiar with the technology in the day-to-day and how it can impact their lives and improve, in this case, their financial returns in their portfolios, is going to be a key thing as it takes its next step in legitimacy. But other than that, I think, we've outlined a pretty detailed report with our outlook. So I would encourage everyone to go check it out. And, I think if this is it for 2024, it's been a real pleasure. I think being co-hosts with you two, and I wish
Likewise.
everybody
Feelings mutual.
everybody a happy holiday season. Let's wrap up
Absolutely.
the New Year strong.
Yeah. So there you have it, guys. It's been, nothing short of a watershed inflection point year in 2024 for crypto. And, a lot of you may have noticed also a bit of a watershed and inflection point year for CF benchmarks as well, which of course you'd expect, right? And judging by this very impressive, in all honesty, report that the research team of Gabe and Mark have put together for 2025, that year looks like it could actually match what we've actually seen. We may see some additional risks. We may see some additional sort of like stress, both for ourselves as investors, but also out there in the world. But nothing short of the excitement that we've seen this year, and it'd be great to share with you guys as we shared this year with you guys. So if you enjoyed that, you know what to do. You need to scroll to cfbenchmarks.com. You need to find the Research and Insights tab, click it, and you will find the 2025 Outlook document as the first item there. You can also, of course, navigate to cfbenchmarks.com for all of the other amazing research team content that has been published thus far this year as we come to the end of the year. And obviously familiarize yourself with the sections that we've actually set up, because this is where you'll find the content that's going to be available, the new content that's going to be available in the coming year as well. As for the podcast itself, it's been amazing to share this year's journey with our audience. We appreciate you. Show your appreciation a little bit more by liking and commenting wherever you watch the podcast. We're available on Apple, Spotify, Amazon, and others. So do go there to update yourselves with all of the episodes, any episode that you may have missed. We will see you again once you've done that for another episode in 2025 of CFB Talks Digital Assets. We appreciate you guys. Thanks very much for joining us.
Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice. This recording is not intended to persuade or incite you to buy or sell any financial products noted within, including but not limited to exchange-traded funds, mutual funds, equities, other instruments that reference any index provided by CF Benchmarks Limited, or crypto assets. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making an investment decision. Note, some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.